world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Shamir Karkal, co-founder of Simple, and now co-founder of Sila. Founded in 2009, Simple was the original digital bank, conceived and built to give people more control over their money. After a few successful years, Simple was acquired by BBVA, under whose ownership it operated until early 2021, when it was shut down. Simple was loved by its users and mourned following its closing, in what was a sad moment for fintech. Today's breed of digital banks, including Chime, Varo, Current, and others, inherited a lot from Simple, who pioneered the space. However, few of Simple's most popular features have been replicated by other players. In recent years, we've seen huge user growth achieved by fintechs offering banking to previously underserved customers, especially those living paycheck to paycheck. Nevertheless, Simple leaves a powerful legacy and many lessons learned for the entire fintech industry. In this conversation, we go deep on what worked and what didn't for Simple, why it never hit escape velocity, why its users loved it so much, and how Shamir and his co-founder Josh engineered life-changing payouts for their employees through the BBVA acquisition. We also discuss Shamir's current company, Sila, which is building programmable money for the next generation of fintech companies. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Shamir Karkal. Shamir Karkal, welcome to Rebank.
Thank you for having me.
Look, it is such an honor to connect with you. I've been looking forward to this conversation. You're one of the grandfathers of digital banking or neo-banking. In fact, maybe even along with your co-founder at Simple, the grandfathers, right? Like this was, what was it, 2010, the concept of putting a bank branch on a mobile phone.
It was 2009, actually. July of 2009, when I was a consultant at McKinsey in Brussels, and Josh, who was my ex-classmate and good friend, sent me an email saying, let's start a retail bank. And you'll see how crazy I am that in the summer of 2009, right after my last project at McKinsey at that point was actually like a massive bankruptcy in Europe. And with that experience right behind me, I was like, yeah, it's time to start banks.
Well, I feel like you had to have been crazy. Firstly, to respond to someone who sent you an email, someone who purported to be your friend, saying, let's start a retail bank, but then responding in the affirmative.
Well, so there was more background to it than just that, right? Like, so Josh and I were good friends, and I'd spent 3 years at McKinsey at that point, a little bit less, doing financial institutions stuff. So a lot of different things, but much all of it around sort of payments, banking, insurance once, but all in financial institutions. And Josh had he was a startup guy. So he had sold a startup in Australia before he came to business school. We met at business school at Carnegie Mellon. And after business school, he went back to another startup. But it was like a fintech / ad tech startup called Root Markets, which did well for a while, but eventually ended up failing. He then went and worked at a hedge fund. So we stayed in touch, and he was in New York and I was flying all around the US and then the world doing financial stuff. And we'd keep chatting about different things. But eventually in 2008, that became a lot about the developing financial crisis, right? And trying to figure out what was going on. He was doing a lot of work in the mortgage space. mortgage space advertising. I was doing a lot of work in mortgages, in like trying to figure out the broken mortgage system in the US. And so yeah, we'd spent probably the 18 months prior to this discussing different aspects of the broken financial system, which there was a lot to talk about. And he, on a personal basis, got very frustrated with his own personal banking, and he went online and he just tweeted, actually, on Twitter, which was very new back then. Can somebody introduce me to the folks at Mint, because I want to punch them in the face? He's Australian. He used to be a lot less politically correct than he is now. And so some VC asked him, like why? And he was like, because their product is so bad. And then the VC was like, well, build something better, right? Like, don't curse the darkness, light a candle. And Josh is like, I am a startup guy. I should build something better. What would I build better? And he thought about it, and he was like, the problem with Mint back then, and even today, I would argue, isn't that the people at Mint are bad. It's just that getting data from bank accounts via screen scraping and then trying to help customers understand their finances using that data is a horribly tough thing to do, because the data itself is pretty garbage to begin with, and then you have no real ability to help customers beyond giving them advice which they frequently don't understand and will mostly ignore. And so the right solution isn't to sort of like try and build a better layer on top of somebody's bank account. It's just to build a better bank account. That's what people really need. So why don't we build that and give it to them? And that's where he sent me that email, which was very well thought out. He broke down like what a bank is, how they function, how banks in the US suck because their primary business model is to make money by keeping customers confused, and then fee them to death. What if we built a bank that didn't do that and actually helped customers manage their money and gave them advice based on their data and aligned itself so that it succeeded when the customers succeeded, rather than saying, aha, you made a mistake, here's a $35 overdraft fee. And what would that look like? And I was like, well, that's a fascinating idea. And here I am 12 years later, right?
Yeah. Okay, so look, just picking up right there, I guess. So here you are 12 years later. And what about those initial assumptions, that initial premise that you guys had, do you think is still valid? What do you think has changed? And as you kind of look around the fintech market now, and you're a founder of a fintech, which we'll get into, as in another fintech, Post Simple. How do you think about the dynamic and the landscape that we're in now vis-a-vis what the market looked like at the time?
Well, I actually, that original email which Josh sent me on Friday, July 17th, 2009, I actually blogged it on Medium. So you can go to medium.com and search my name, and you'll find simple tale in the beginning. And that's the original email verbatim that he sent me, right? And my reaction on kind of like looking at it now is I'm like, this is such a great idea. Somebody should actually do it. The hard part of it is that when you read that, it's just very well laid out and quite straightforward. And now after 12 years, I can say that one lifetime is not enough to actually do everything in that email. Right? The banking system is... I did not think back in 2009 that the banking system was simple, but I now understand how. I have a much better understanding of its complexity and how hard it is to actually do the things that were laid out in that email. So I feel like I'm about halfway through para 2 in that email in terms of executing on it, and I feel like there's at least another 20 years to go. And that's one thing I think that most people don't get even now, is just like how vast and complex financial services actually is. If you look at the global financial services industry, well, actually, if you look at global advertising, it's a $600 billion a year industry. And this is what has been completely transformed by like Facebook and Google and the first wave of the internet revolution. It really changed advertising. Um, Financial services is a 17 trillion industry globally. And it is still controlled by like 30,000 financial institutions, more banks, but also brokers and all the others globally. Everybody from PayPal to Sila, all the new fintechs across the world together, I don't think have even 1% market share today. And that is the story of this decade of the 20s is probably of the fintech revolution going from like 1% market share to like 10% market share, which means that, and of course, financial services itself is growing. But the real economy of the world is like 100 trillion in GDP, and it's made up of like, manufacturing and financial services and transportation and agriculture, for God's sake. It's still a huge thing. Advertising is a tiny slice of the global GDP. Financial services is a giant chunk of it, and the fintech revolution is barely getting started now.
Yeah. So advertising there is like a kind of a proxy for stuff like industries that have been disrupted by digital.
Yes, and I think that's right. Like the industry that's been most disrupted by digital in probably 2010, and even today you could argue, was advertising. But now, since 2010, things have changed, right? Like transportation has been heavily changed, right? Space is just beginning to change, and logistics across the globe, you can't consider that transportation, or is also beginning to change. A lot of those sectors, if you looked at the breakdown of global GDP in 2010, and we're like, what's been the internet impact on this? And you'd be like, advertising, very clear. Most of the others, you would have had to like squint to see any impact at all. Today, oh yes, everywhere there is impact. It's still small though, but same thing for fintech, right? Or financial services. Fintech is going to change a lot more of it in the next 10 years than now. It is just gigantic, and it's heavily regulated, and we as society have decided to keep it that way, right? The advertising is mostly unregulated, financial services mostly heavily regulated, and we want it that way. I might be irritated by seeing the wrong ad or whatever, but I'm going to be very pissed off if I lose my money. Health and wealth are the two most important things for most people. Those are some of the most heavily regulated industries, and they are the most slow to change, but they're also gigantic.
Yeah. Okay, so I've been in fintech for a mere 7 years. Nothing compared to your 13, going on 13 now. But I have this, so I share your optimism, right? Like it would be very easy based on the first half of what you just said there about how everything in fintech equals less than 1% global market share. It'd be easy to look at that number and say, okay, you know what, we should stop and go do something else. But actually, you've gone back in and you founded another company, Sila, which again we'll get into, and I certainly have also, and I think like you, more energized now than ever. And if I think back to, I guess like even a year ago, so pre-pandemic, I guess it kind of did feel like we were still waiting for the early promise of fintech to break through. And then in this 12-month period since then, whether it's like Coinbase, Robinhood, Chime, market share, and you can just kind of go down the list. But there's a full suite of basically consumer financial replacements for incumbents that have really started to break out over the past 12 months. And some of those, I think, certainly Coinbase and Robinhood, we should have. Coinbase, we already do have a detailed view, but Robinhood, I think very soon, these companies are finally to go public. So it'll be fascinating when we can really start to dig in. But what in your mind has changed from whatever it is, 5 years ago, 3 years ago, 2 years ago, to today? And what are the forces that mean that the decade of the 2020s will be the time for fintech?
So there was the forces haven't necessarily changed. It's just that the pandemic, I think, has accelerated changes that were already happening, right? So, uh, already in 2010, a large chunk of the American population had a smartphone, right? I don't know what it was, probably maybe 50% ish, but not globally. Most of the globe didn't have a smartphone. I don't know the stats right now, but I suspect, probably half the world has a smartphone by now. I know hundreds of millions of Indians have smartphones, hundreds of millions of Chinese, and across Africa as well, right? And so the kind of this push of like large numbers of people getting online, but like all the time, not like, you know, an hour every 2 days, like in the early 2000s or late 90s. It's now you live your life, you're constantly connected. And it's probably 2-3 billion people who are like that. So that's steady, it's not steady, it's been pretty explosive growth over the last decade has been going on, right? So, at the same time, specifically within like financial services itself, one of the things that has changed the most is across the globe, but especially in the US, the attitude to innovation. I remember in the crisis reading this article where quoting Paul Volcker, who was ex-Fed chairman, very, very famous guy, who said that the only good, like financial innovation in the last 20 years is the ATM, or last 50 years, I think he said. And and I was like, well, I'm not sure I fully agree. There's been like, debit cards too. I think there's been some other cool stuff that's come along, but I could see where he came from. Innovation in finance in 2009 was a dirty word, right? There was a lot of regulators who were like, let's get all the innovators out of the industry, kick them somewhere, put them on an island, sail it off into a ship, whatever, and let's go back to banking the way it was done in the 1950s, right? Because in their mind, the financial crisis was caused by financial innovation. And they didn't see fintech startups. All they saw was Wall Street bankers creating complex derivatives and blowing up the global economy, right? And they wanted to put a stop to that. I can sympathize with them on that one. But I'm like, there is other types of innovation. But, innovation around product, around technology that consumers could actually use, that wasn't something that regulators even understood or thought about in 2009. That's changed completely now. Every regulator on the planet financial regulator on the planet knows that fintech is here to stay and it's not going away. And and I would say actually fintech innovation, the sort that driven by technologists like us, is broadly viewed positively. Not always, not every aspect of it, not every regulator, but the broad view of it from the regulatory community is that this is the sort of innovation we want to see more of within limits, not the sort of innovation we saw pre-2008 coming from Wall Street, right? And I think that's an attitude that's developed over time, and it has led to many good things, right? There's just like the whole bank chartering thing that the UK did and created all these new banks. A lot of the regulations around SEPA and PSD2 that came out in Europe. And not so much necessarily like hard regulation in the US, because the US legal and kind of legislative system precludes like changes. But Dodd-Frank did happen in 2010. And since then, the regulatory field has been set, but within it, folks like the CFPB and others have been broadly supportive of innovation, right? So I think the regulatory attitude has changed. The customer adoption has changed, and all of that got massively accelerated in 2020 in the crisis. So it's not like Coinbase didn't exist in 2018. Coinbase, Robinhood, Affirm, TransferWise, all the other big guys were already big in 2018. The pandemic just meant that, there was a moment in March of last year where it didn't matter if you had spent 50 years walking into your bank branch on a weekly basis. In most developed parts of the world, you now had, even your 90-year-old grandma had to download an app on her phone and figure out how to do online banking. So you saw a massive step change in a graph which was already trending up, right? So all of these companies just got a lot bigger, a lot more rapidly than you would expect for companies that were already big. Chime already had millions of users, and I'm sure all the others did. They got many more millions than they would expect in the pandemic. And they probably saw like 5 years of 10 years of growth happen in a year. And so suddenly that made it obvious to everybody that fintech is here, fintech is big, it's not going away, and change has just accelerated.
Yeah. 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 I guess, yeah, like another way to think about what you just described there during pandemic, it's distribution. You know, the distribution model is different. It's download the app, no matter where you are. It's pretty instant. Account opening is pretty quick, versus the in the analog model and the extra work that was associated with that, and the shift of I guess like our surroundings meant that we had to, people that had been hesitant to pursue these new distribution channels, now like that became the default.
Financial services has a lot of inertia. All of those things were possible even in 2018 and 19, and more people were doing those. It's just that it was a steady growth, right? The pandemic forced a step change where a lot of people who wouldn't have tried it till like 2024 maybe on their own timeline just had to do it all, and that just accelerated everything.
Yeah. I guess the other thing that comes to mind for me too is the infrastructure, the quality of the infrastructure. And if I think about basically the stack we're building on now with Bella, our current neobank, versus what we were doing with Alica in the UK, circa 2015, 16, 17. Like we're just talking about a fundamentally different set of component parts, and the speed of development, the quality and richness of product and experience that we can build now, and the speed and cost effectiveness with which we can distribute it. I mean, it's unmatched. If I think even just 5 years ago. Plus you made the Mint reference circa 2009, and I suppose everyone's probably had their own direct or indirect experiences with Plaid. It's still fine. It's not perfect. There's no faster payments network in the U.S. So there is definitely still some infrastructure overhead. There's no open banking regulation in the U.S., which standardizes data sharing and data portability the way that it's standardized in some other places. But the fact that you can now access data from these disparate sources and start to facilitate these like much higher speed types of experiences, I think has to be one of the main drivers too of the speed of adoption.
Yes, it's infrastructure has improved massively. I still wouldn't characterize the quality overall as good, but it's gone from like abysmal to beginning to get pretty good. Now I am biased. My current startup Sila is an infrastructure company ourselves, and so we do onboard fintech startups, every type of startup really, and the large companies too, and help them program with money. But we regularly get customers from like signing a contract to live in 8 weeks or less actually, and that's something that even 5 years ago would have taken you 18 plus months to build a basic fintech app. And I still don't think 8 weeks is good, by the way. I want to get it down to 8 minutes. But that's that's the next leg of the journey for us, to make it truly easy and simple to build an app that programs with money the same native way that you can program with email or voice over IP or SMS or any internet protocol. That I think that truly democratizes innovation, and that means that anybody with very limited resources can create and ship an app, and that just means that instead of having 1,000 fintech startups, we'll probably have 1 million. And I view that as a great thing. It's better to have 1 million apps in the app store than to have 10. Not all of them will survive, not all of them will work, but many more great companies will be built, and a lot more customers will have better experiences through having a lot more product availability, but also a lot more variety, right? Like if this was one of the things that if you look at banking, even up until I suspect like 2014, when last time I saw these numbers, was the choosing a bank account in the US was mostly driven by location, right? If there was if there was a Chase bank account that was on your side of the street from where you lived, you were more likely to open an account with Chase than with Bank of America across the street. And bankers viewed this as like the reason to build, thousands and thousands of branches, right? But when you look at it, it just goes to speaking about how undifferentiated the brand proposition was, that the average customer couldn't be bothered to cross the street to choose Bank of America over Chase. Right? That's how undifferentiated the product and the brand and all of it was, right? The single biggest driver was like how many feet away the nearest bank branches, you'd pick that one. And I think that can change when it's all in an app store, and the you can put any app on your home screen just as easily. Well, it comes down to which app really speaks to your product, your needs, and to you as a person.
Right. Because then at least people can choose based on color, right? Not by distance.
Hey, I still think if that's what floats your boat, you go for it. But people actually are surprisingly good with money. I mean, they're also surprisingly dumb many times, but you'll find that a lot of like what seems to be like dumb behavior from people is really just driven by kind of the financial situation that folks find them. When it comes to actually making choices, given that there are good choices available, you'll find that people broadly do quite well. The main problem is that for a lot of people, there just are no good choices available.
So I'd love to dig in there actually and kind of rewind a little bit back to the simple journey, and then we can bring it back to the present, talk about Sila, and then your thoughts on where we go from here. So I mean, I don't know where to start. If I ask like the most interesting question for me, like looking back on Simple, what do you think you guys did particularly well? Whether it was from concept design, any like engineering decisions you made, company building decisions, fundraising, whatever it was. And then what would you do differently, if you were going to do it all over again?
I think the core of Simple's everything really was just that customer-centric mission. I mean, that was laid out in Josh's original email, which was build based on what the customer wants and what's good for the customer, rather than how banking has been traditionally done. And that informed a lot of everything at Simple. And that was the best parts of Simple, right? Like product features that we innovated on, big ones like goals, the idea of automatically saving money for customers and giving them not just, hey, you should save money because it's good for you. That's like saying you should eat your vegetables because they're good for you. We know from from how that works on the health side. On the wealth side, it's really just say, hey, create a goal for like you want to go on vacation to Europe next year when travel is easy again, right? How much do you think it'll cost? $2,000. Let's start automatically putting away whatever, $20 a day. Right. And while you're doing it, it's happening automatically without you even thinking about it. Guess what? A lot of people will magically find themselves with $2,000 a year from now. When you frame it that way and run it that way, because that's how people think. There's this whole industry on the health side, right? About Fitbit and being constantly aware of what you're doing. And there's so much science put into that. Even today, now, there is still so much less of that on the financial services side. And so much is focused around educating people. It's not about educating them. It's about building the products that work the way they think, rather than trying to get them to think the way that accountants think of money. So I think that core piece of the Simple philosophy was probably the one part that informed everything. And that led to the kind of the best parts. I think the problems that Simple ran into, I mean, we were first-time founders. We made a lot of the kind of the common mistakes around how to build teams and everything else, which we went back and fixed. And I don't think we did anything too bad, really. But I'd say the biggest problem that we ran into over and over again was just finding a bank partner and infrastructure providers who were stable and could actually do what we needed them to do, because we couldn't do everything. I mean, it wouldn't have been legally possible, it wouldn't have been financially, technically possible. We'd still have been trying to launch now, 12 years later. So we needed to rely on partners. And just the quality of those partners and infrastructure and everything else was just so much lower. I remember talking to a sales rep from Fiserv. Was it FIS? One of them, and he was telling us about how their bank core could do anything we needed. And at the end of it, I was like, "Great! Can you send us your API docs?" And he was like, "API? What does that mean?" And I was just like, "You're selling a technology product in 2010, and you don't know what the word API means?" I mean, but that's what it was, right? Like, they were selling mainframe-based products in 2010, just like they were in 1985. Nothing much had changed for them. I'm like, no, this world has changed. Now everybody has an API. Everybody understands that, you need to serve developers. You need as well as like the bankers, and so that quality of infrastructure improvement has improved massively. I still think there's a long way to go. And it took us 3 years from first email to launch at Simple. But it's not because it takes 3 years to build a web and mobile app. It took 3 years to find a bank, find a processor. Okay, that's not going to work. Find another bank, a few more processors, figure out how to connect all of them, and do all the compliance and regulatory stuff around it. And then build that internal API platform on top of which you can then build the web and mobile apps and launch it, right?
Yeah. So I spent some time, just kind of poking around post, the announcement, the recent announcement of Simple being closed by BBVA, and just saw this outpouring on, like basically Reddit and other, forum type sites of customers and the pain that they were experiencing as a result of that, and firstly, I think that when customers bring any sort of emotion to a financial company that isn't anger, then you're doing something really right, And then, so not only were people really upset that Simple was folding, they were concerned because they didn't see anywhere else that they could get the same features that they use so much. And the vast majority of people were talking about budgeting and the budgeting tools that they use Simple for. I wonder if you could talk a little bit about, I guess point number one, like why people loved you so much, and point number two, this set of budgeting tools specifically, and why there's no solution for former Simple customers to go adopt.
I think a lot of folks who came after Simple looked at the problem as a budgeting problem. How do we help people budget? The truth is, there's maybe a small percentage of people who think like accountants or actually are accountants who enjoy budgeting. The vast majority of people never want to create a budget if they can avoid it in their entire lives, right? So if you try to create budgeting features and offer them to people, you'll find that they aren't really going to get much usage. The way we always approached it is, what do people actually want to do? They want to get control of their money, right? That feeling of being in control of your finances is powerful. It's like being in control of your health, and you feel like you're healthy, you feel like you're wealthy, even if you're not making tons of money, right? But you know that you're spending what you can and you're not spending what you can't. That feeling of control is what we strived for, and that really resonated with people. And I think that is the key to the differentiation. Don't think of it as like budgeting. Think of it as helping people get control over their finances. What that comes out in is features like goals, where you could just, you can think of what your goals are in life. Give yourself 5 minutes and you'll come up with like 20, and then try to make them, what are the monetary ones of those, put them into your app. You can do that in 20 minutes, right? Like if you ask most people to sit down and create a budget, they wouldn't struggle. Tell them to ask them what their goals are, they'll come out with that easy, right? And so that way, build it into the product, help them automate that. Then ask them a few questions. Do you want to contribute into this $2,000 Europe vacation goal on a daily basis, or on whenever your paycheck hits? A lot of people will say paycheck. Well, then don't ask them when their paycheck hits. You can figure that out. You are their bank account. You can see when their paycheck is coming. It shows up on a pretty regular bi-weekly, maybe monthly schedule. So just detect it, do it automatically. Whatever you can do automatically, don't ask people, just do it automatically. Err towards being right, and then just do it. And that design philosophy of like doing what's right for the customer, doing it automatically, and thinking of it from the way humans think about it and helping them, that inform things like goals, that inform things like expenses, which is like automatically assign your expenses to your goals. Right? So if you have a goal for like rent payment, when the rent payment comes in, just attach it to that goal. It's done, right? And so your paycheck comes in, your twice a month, your rent payment gets debited from that paycheck and put into a goal. The rent comes in, it hits that goal, money is gone, and you never have to think about this again. Your rent will get, as long as you keep making that paycheck, your rent will get paid. That's it. It's done. Set it up once in 5 minutes and forget about it for the next rest of your life. Do the same for your 20 biggest expenses. And now suddenly you'll realize you have like $200 or $2,000. But this is the true money you have left over. Right? That's your true safe to spend, which is also a concept that we created at Simple. And the way all of these features work together is to give you that financial control. I don't think anybody else ever approached it with that mindset and thought of it that way. That's why nobody else recreated it.
All right, so I want to ask you a very an intentionally simplistic question. I'm really interested in your response. So because of this emotional outpouring, like that leads me to believe that Simple customers really loved Simple. And so if that was the case, why didn't Simple have 10 million customers?
Simple spent a few things, and some of this I know, some of this I'm going to have to surmise, because I left Simple myself in 2015. Simple spent so much, or we spent so much of our time at Simple just fixing our back end issues, right? So I talked about how it took so long just to build the back end and then launch it. But then sort of 18 months after we launched it, a little bit more, but like less than 2 years after we launched it, acquired by BBVA, which then meant that we had to transition again to a new backend that was built on BBVA instead of the bank partner which we had before. That took more than 2 years. And then once that was built, the company to some extent lost its kind of product evolution and mojo, right? Like if you look at Simple in 2017, 18, it was still pretty much all the cool features had been built pre-2015, right? And getting back to that, when an entire company's 90% of the engineering effort is devoted to one massive project that takes 2 years to do, then after that, waking up and saying, hey, now we have to start becoming cool and shipping things on a 2-weekly schedule again, and all of that just gets really, really hard. And I think Simple was, as far as I'm aware, still growing, still probably not the largest. I think Chime is easily the largest neobank now. Maybe Varo current, but definitely one of the top 5 neobanks even at the end of last year. Right? It was still big, it was still growing. It just didn't grow fast enough, and it still wasn't big enough to matter. A large part of that I just attribute to the velocity that was lost in massive like infrastructure switches.
It's tough as a fintech person, on the startup side of the spectrum, not to attribute part of the slowdown in speed to ownership by an incumbent.
Oh, that didn't help, I'm sure. And I think I wouldn't blame BBVA entirely for that. I mean, they tried their best to sort of keep Simple separate and try and keep the magic bottled for as long as they could. But at the same time, they are a large incumbent bank, and you could, especially from sort of like 2015, 16 onwards, you could see folks like Chime and just the sort of stuff that they were able to ship and they were able to do, and sort of key features, right? Like Chime's 2-day early direct deposit. that was something that I worked on with Bancor back in 2012 or 2013. It's the way it works isn't rocket science. You just have to understand the the ACH timing schedule and implement it. It's something that simple, and for that matter any large bank has just been unable to do yet, but yet it's a standard feature of almost every neobank. And if you can't do that, then you're going to lose out on a lot of customers for whom that's a big feature, right? So things like that, I would attribute to BBVA wherever. But there was a lot of product stuff that Simple could have done independent of like those sorts of limits, which some of it did do, but just clearly not enough quickly enough.
Mm-hmm. So any sort of non-compete that you had post Simple notwithstanding, when you went back in as a fintech founder, you picked infrastructure and not consumer digital banking again. Why didn't you try to start Simple too, having learned from all the mistakes?
I think there's just a lot of people who are trying to do Simple 2.0, 3.0, and also like every other version of Simple. And I feel like at Simple, we used to have this ideas repository. And especially in that 2013 to 2016 timeframe, when there were so many fintech startups that got launched, because before 2012 there were almost none. But like Acorns and Digit and Robinhood and all these that got launched, there would almost be this like thing in the Simple internal chat where it was like, oh yes, Acorns, this is idea number 365 in the Simple ideas directory. I have not yet found one fintech that got launched that wasn't one of the ideas in the Simple ideas directory. If you take like 50 smart people and give them a couple of years, they'll think of every idea out there, right? The gating factor was not Simple's ability to come up with cool ideas. It was Simple's ability to execute on them, which was it I don't know. I don't think we ever got to even 1% of the ideas that we wanted to, right? So and I was the guy on the Simple team who was primarily responsible for the internal infrastructure. So I did the bank deals, did the processor deals. I figured out how to cobble all of that together and build that internal API platform. And then I did that again at BBVA in Europe and in the US. And I'm now doing it again. So for me, I am kind of building not just Simple 2.0, but probably Simple 3.0. But it's a piece of Simple that I've built before. So for me, this is what I do, right? It's just that this time around, I feel like I want to see more than 1% of those ideas actually executed. And that's why Sila is here.
Okay, so the reason I reached out to you was because I saw a Twitter thread that you wrote. And it must have been, I don't know, 5 or 6 months ago now. But specifically, was it that long ago? I don't know. Time is a blur. Pandemic time. But specifically, you were talking about the way you treated your employees at Simple through the BBVA acquisition. I wonder if you could expand on that a little bit. You were talking about specifically financially and ensuring that people participated in the sale. I wonder if you could talk a little bit about that just to set the scene, and then maybe expand on your kind of approach to being a startup founder, not the technologist, but the team builder.
So the thing that we did when the Simple sale happened, which was in early 2014, it was 117 million was the sticker price, and there were about 100 employees. Whatever, 97 excluding founders at the time of the sale, and we fully accelerated and fully vested everybody's options. Everybody had stock options in the company. If you understand stock options, you know that they're an option to buy stock. They're not actually stock itself. And you typically get a grant which vests over 4 years, and you have to work there for 4 years to get the full thing. We took everybody's 4-year grant and just gave it to them at sale, all of it, and then cashed it in and paid them in cash for it, right? So that itself worked out to I think it's going to be about $8 million that got paid out to those 97 employees. And remember, some of those employees, like I think some of them were less than 6 weeks old. So they got 4 years of vesting for working 6 weeks. Um, and But that wasn't enough, because that was just a nice amount of money. Nobody was actually going to get rich off 8 million split between 97 people, right? And so we took another 6 million, little bit more, 6.2 million, I think, off the top, and then distributed that to the same 100 employees, excluding the founders. And we specifically set out with the goal of trying to make as many people like actually rich as, $5,000 is nice to have, but it's not life-changing money. If you're a 23-year-old and you get $400,000, that is life-changing money, right? And we set out to make life-changing money for as many people as we could, and we succeeded. I think there were a couple of people who got close to $1 million, like more than 20 people who got like 300,000 plus, and dozens of people who got like 50, 100K plus. It all depended on how long you had been working there, what your, position was within the company. But we had customer service people who came into my office on the day of the announcement, thinking that, because me and Josh split up the company and spoke to everybody, right? And they thought that, spoke to everybody individually, and they thought they were being fired, right? What, the company is being acquired, and then I have to meet the CFO, and then I had to explain to them that with 3 weeks from now, when the sale closes, you're going to make like 200K in cash in your bank account, and people were just like, they didn't know how to deal with that. Like, it was amount of money which most people had never seen. Like, people went out and bought houses, and I think we set off a mini housing boom in Portland. And I think, and I have no regrets. It's one of the best things I ever did. I mean, we set out to make as many people rich as we could, and we succeeded to the extent possible.
Yeah. Was that an act of generosity or an act of doing the right thing?
I mean, objectively, it was extremely generous, right? Like typical acquisitions that I have seen, I've never been in the driver's seat, but I have been an angel investor fairly actively for the last few years. So I've seen this happen a few times now. Most of the time, the deals get struck in back rooms between between like management and acquirers, and somehow it's always the management that ends up becoming rich, and employees get a little bit of money, usually with like having to work there for 3-4 years. All of this 14 plus million that we paid out to employees was paid out at close. None of them had to work a day after the acquisition to get any of it. And on top of that, we then gave them huge pay increases and lots of incentives to actually stick around. So there was no strings attached to this. It was money, and then take it and walk out if you wanted. Actually, many didn't. Some did. Some people went off to start their own companies and do other things in life, but a lot of people stuck around. So I guess objectively it was generous, but that wasn't how we were thinking about it at the time. We weren't thinking about it like, hey, we need to be generous to people. We were just thinking about it like, Josh and I made a lot of money as well. We could have made more if we hadn't given away if we hadn't been that generous, I guess. But we were just like, hey, we are going to make life-changing money, and we're going to try and make that happen to as many people in the company as we can.
Beautiful. Okay, so then fast forwarding to today, you went back in, for round 2 post Simple, and you're now the founder of Sila. So tell us about Sila and why. We touched on it before, but why specifically, this opportunity attracted you?
I feel like this is just an evolution of what I've been doing for the last decade, in many ways. The vision and the mission really is to make money programmable. If you wake up tomorrow as a developer anywhere on the planet and you want to program with email or voice over IP or SMS, it's quick, it's easy. There's APIs, SDKs, whole ecosystem of providers. The hard thing to do is to compete with Gmail, because it's a damn good product. But most people who are programming with email are not building superhuman, or hey, they're just embedding some email flow in an existing application or business process, it's probably quicker to do than to talk about it. The moment you come to money, it's a totally different world. Whether you're in San Francisco or Shanghai matters a lot. There's almost no APIs or SDKs even today, and you end up having to work with a few hundred banks globally, and maybe a few dozen in the US, which is better than the zero that it was 12 years ago. But it's still not a lot. And the banks still suck mostly. I mean, they suck in different ways in different parts of the world, but they still don't have great technology. They are heavily regulated, and for the most part, don't know how to manage that. And they still don't have the kind of the understanding of developers that I think is needed. And the end result of it is that it is still expensive and costly to build a basic financial app. If you end up building it, you'll realize that competing with Bank of America is much easier than competing with Gmail. But again, most people who are programming with money are not building a neobank. The vast majority are just embedding some payments flow into an existing application or business process. Like, which business process needs money? Like, hell, all of them. And so the market is gigantic, and it's very badly served by the current banking industry, but it's still huge. And yeah, that making it possible for that developer waking up 5 years from now to onboard their end user in the US and in Tanzania and pay out and pay in and program with money and build whatever they want to quickly and easily. That's what Sila is here for.
Wow. So what are some of the leading use cases that you guys are focused on right now?
Oh man, there are so many, and it's kind of really hard to describe because we have customers across fintech, wealth tech, crypto, real estate, reg tech. I mean, every regulated payments capability is we probably have a customer in it. We don't really focus on e-commerce. I think that's the one part of payments that is actually well served. Folks like Stripe have built an amazing business, and if you just want to buy and sell goods online, it's there's Stripe, there's Adyen, there's checkout.com, Shopify. There's a bunch of ways to do it. All are good. Just pick which one works best for you. As soon as you get into regulated payments and you're like, hey, I need to comply with the Bank Secrecy Act and verify identity and do AML and all of this stuff, and then I need a bank partner and an FBO account, and suddenly I'm a year into this and I still haven't written a line of code, right? That's the market that is, I think, very badly served, and that's what we focus on. So yeah, we have customers like Charlie is one of my favorites. HiCharlie.com, I think, is their URL. It's a PFM app, and it's a really cool one. I use it myself actually, and yeah, they're a great startup based down in the Bay Area. They came to us like a year ago, signed up, launched in actually I think less than 4 weeks, and I've been growing their business nicely. And that's our bread and butter customers. We have much smaller pre-seed startups. We have public companies as customers, but kind of that middle stage is really where most of our customers are.
Mm-hmm. Amazing. All right, so this sounds like crucial infrastructure, and it sounds like you're 100% right that 5 years from now, probably less, this is the sort of stuff that one of the platforms that developers will be going to first to build new fintechs. So on that note, I mean, as you look forward from here, of course you're going to be focused on Sila, but I'd be interested in any parting thoughts on how you see the fintech landscape evolving from here.
Gigantic growth, but with bumps in the road, and bumps in the road of almost, I think, every stripe. But I think there'll be a lot more regulatory scrutiny of the whole sector as it grows and becomes just a massive part of the ecosystem. I think there's going to be a lot more pushback from the incumbents than there has been. Now it is a question of survival, right? Like if you look at the UK, for example, TransferWise and World Remit and Asimo and all of them, the international payments used to be a nice business for UK banks. That business is gone. I don't know if anybody's making money on international payments, not on the retail side anyway. That more and more of that is going to happen, right? Trading stocks, it's all gone to Robinhood, and everybody has to go to zero fee now. That sort of stuff is happening across the financial system, and it's not even retail. It's when it starts happening to commercial and large customers. That's when it's really hitting the bank's bottom line. So I expect the banks to fight back and push back. But I do think it is inevitable, right? Like nothing can stop an idea whose time has come. The fintech's time has come. It will be this decade. And I think by 2030, fintech in 2030 will be larger than all of tech in 2020. I do expect at least one, if not 3, 4, $5 trillion fintech companies. I expect to see a bunch of $100 billion fintech companies and lots of $1 billion companies. You just look at the numbers and you're like, it's hard to see, it go from 1% to 10% of global financial services without having those sorts of giant companies. I mean, you look at PayPal and even Stripe as a public company, they're not that far away. And so, yeah, those guys still, I think, have another 10x growth in them, funnily enough. And there's a lot smaller ones who will get there over the next decade too.
All right. Well, look, you being a former McKinsey consultant, I put a lot of stock in your analysis. So we'll look forward to that.
Yeah, call me up in 2030 and tell me where I was wrong and where I was right.
Fantastic. Shamir, look, this has really been a pleasure. I can't tell you how appreciative I am of your time. It's been really, really great to talk to you.
Same here. Thank you for having me.
Well, look, congrats on everything that you've done over the course of your fintech career, and all the best with Sila.
Thank you so much. Well, glad to talk to you, and thank you for having me.
Shamir Karkal, thank you very much for joining us today. Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.